Welcome back to Market on Close. I'm Sam Bartis, live from the floor of the New York Stock Exchange. It's time now for overlooked stocks. Shares of Cloudflare have rallied to a record high today after the company reported revenue growth of 31%, and Q4 full-year guidance came in above consensus. I'm now joined by George Tsilis, as senior markets correspondent, to get us across that name. What did you make of the report and the reaction in the stock we're seeing in Cloudflare today, George?
Well, first off, I think the actual report, as well as the guidance that can be provided, is commensurate with what we're seeing in price action. So I think it fits what they've talked about. But for those that don't know, this may be a little overlooked for a lot of folks, but this is an extremely important and actually growing company in content delivery. Everything from web optimization, load balancing, if you will, or smart routing of technologies to the edge cloud computing, which is faster and it provides more rapid deployment of things like data, media content, as well as optimizing web traffic. So that's sort of a super fast traffic controller for the internet. They do compete with companies like Fastly or even Akamai, which I've talked about both on this program. But nonetheless, really a nice report today, as well as some nice price action in the last year. The stock almost double where it was, up 180%. If you look at the top line sales, they actually came in ahead of estimates at $562 million versus the $545 million posted on an estimated basis, but also quite a bit higher than the $430 million they posted last year for the same quarter, as well as about 7 cents higher than last year, 27 cents, beating the estimates, which were 23 cents. And again, last year they earned about 20 cents. But if you dig down deep into the numbers, one of the line items that I found very compelling as to why we're seeing such a nice price movement was they actually posted a break-even, $0.00 on a GAAP basis for net income. They were expected to lose 7 cents a share on a GAAP basis, or if you will, on a non-adjusted basis, but they're at break-even. And this is important because the company hasn't posted any positive net income ever. And this seems to be the first quarter where at the very least they're breaking even. Considering last year on about $2 billion in sales, they lost around $100 million in net income or net loss. So it looks like they're at a break-even inflection point. And then with that said, they also gave higher guidance, not only for next quarter, where they adjusted the top line sales to about 589 from 581 million, as well as increasing the adjusted EPS to 27 cents from 26. So it's just a marginal increase. The 2026 adjustment for the full year was quite meaningful because they were expecting, at least consensus-wise, about $2.75 billion for fiscal year 26. They actually increased that to $3 billion. So that was quite a meaningful increase. And if you annualize that relative to this year, based on adjusted consensus, which is again slightly higher for this remaining part of 2025, it's about a 40% increase in sales. So they're at that break-even inflection point, like I mentioned. Sales growth estimates have been rising, and you're seeing the stock price react. And with that said, you are seeing some of the analysts which cover the stock move their rankings higher because of their modeling of the adjusted revenue numbers as well as EPS. So, for instance, if you look at Jefferies increase their target to 250, Piper to 249, as well as UBS to 245. Just if you look at the average of all these, let's just pinpoint it around 247. It's around $25 higher than the consensus average as of yesterday, which is right around $222.
Yeah, it's interesting because even before this earnings report, the stock was still up over about 100% or so year to date, even before the move that we've obviously seen today. And I was just reading a really interesting sort of Bloomberg write-up about this. You mentioned Akamai, some of its rivals. While it might be smaller than that name, and also Palo Alto Networks, Fortinet, etc., apparently its sort of ease of use has appealed to sort of smaller to mid-sized businesses. The company's also been talking about how their customer base, no customer makes up for more than 2% of its revenue. I'm just wondering what that tells you about the company.
Well, I think it proves, or at least demonstrates, that everyone in the marketplace wants their product. That's actually probably a good thing to see less revenue concentration among major customers, because they do provide technologies that serve many different customers, not just maybe major hyperscalers. So that might be something to consider when you're looking at this company relative to perhaps concentration risk that many other companies have with very few end markets or few customers like the major hyperscalers out there. Again, so I think their technology is becoming more rapidly deployable and readily deployable, accessible, and they are growing their sales. You know, like I said, they're estimated to grow their sales at least 40% based on the additional revenue guidance the company provided, which is quite meaningful. But the other thing is you have to consider some of the risks too in this name, outside of not having the concentration customer risk. You know, the stock is still trading right now at around 240 times this year's earnings and even, you know, 191 times next year's earnings. So they can certainly grow into that number. Growing with profits, net income profits, is very important. Again, that's why I stressed that earlier in the segment. But again, you know, some of the analysts are increasing their targets, but not too much because of the valuation, which is rich right now, already priced in.
Understood. Thanks so much for that, George, as always. You have a happy Friday and a great weekend. We'll catch you later.